probably over the next 3 weeks, there might be some opportunities on the short end. Then when it goes to Europe, we do maintain a short duration position, having in mind that probably on the peripherals, we are not going to see much of a movement in the spread. Where we are more cautious today is on the credit side. So for the time being, we're still preferring the government bonds issuance and then the credit, where we progressively became more and more cautious on the fears of potential liquidity or fundamentals deterioration.
How are we playing the equity market at the moment, Monica? Because you're making the fairly sensible statement that equity returns will be lower compared with the past decade, but better than last year's forecast with regional diversification in focus. And yet the equity market keeps defying gravity despite concerns about the valuation, especially stateside, and the plethora of macro issues going on as well. Do we need a clear out in the equity market before it's safe to buy?
Well, what is happening in the equity market is really weird, because it continues to move higher despite the progressive deterioration of the economic, but also on the fundamentals, so on the earnings. To be honest with you, on the earnings, we've been quite defensive, expecting this recession to be already in place, but this has not been reflected into the equity market that are not pricing in any kind of earnings recession. And this is for us a matter of concern, despite the survey yesterday on the loans that is showing these credit tightening conditions, which is a negative sign, should be a negative sign for the markets. This has not been the reaction of the equity market. So our big conviction, high conviction, is not to search the rally. So we maintain a cautious stance. Having said that, we do position on sectors. So still on consumer staples, materials, industrials, healthcare, with variegate overweight. But overall, on the equity exposure, we are underweight.
Yeah, I mean, it's quite extraordinary, isn't it? I mean, I've just made a note of everything you just said there. It's really weird. The no earnings recession has been priced in. To be honest, we're defensive. We have great concern and high conviction about some of these concerns as well. With all of that, shouldn't our viewers be shorting this market somehow?
Well, as I said, we are underweighting equities, maintaining some relative preference for quality, value. Value is another big call that we have, and it's a trend that will be displayed for years. You know, what happened is that the tightening on the monetary policy has been fast and furious. And we do not believe that the consequences are already displayed on the real economy, for sure, and therefore has not been priced yet by the financial markets.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.